Yields rose 2.5% this week. The Nasdaq 100 fell 2.5%. Those two numbers look like a matched pair, but they are not. For the 10-year Treasury, a move that size is ordinary. For the Nasdaq, it came with the broader S&P 500 losing less than 1% over the very same days. That size mismatch is the whole subject of this episode. Not the direction. Everyone can explain the direction. The size. Here are the exact figures. The 10-year Treasury yield went from roughly 4.566% to 4.679%. The Nasdaq 100 went from about 28,852 to 28,136. A modest move in rates, an extreme reaction in growth stocks. Start with what actually happened to rates. The 10-year opened the week near 4.57%, pushed as high as 4.71%, and the 5-year yield moved even faster, up about 3% to 4.43%. Both were squeezed into an unusually tight range beforehand. This week is where that compression released. Higher yields raise the discount rate used to value future cash flows. Growth stocks carry more of their value in cash flows further out, so that mechanism hits them harder than it hits the broader market. That much is textbook, and it is genuinely active here. But a mechanism being real is not the same as a mechanism being big enough. The question is not whether higher yields pressure growth stocks. It is whether a rate move this ordinary can account for a reaction this extreme. Look at how ordinary the rate move actually was. The 10-year 1-hour RSI pushed into the low 90s midweek, then eased back to the high 50s by Friday's close. That is a cooling reading, not a stretched one. The Nasdaq's finished the week down at 27. Now compare a broader index. The S&P 500 fell only about 1% over the same days, and its RSI finished near 35, weak, but nowhere near the Nasdaq's reading. Same rate move, same week, far smaller reaction, because it holds far less long-duration growth exposure. If yields alone explained this, the reaction should scale with how unusual the rate move was. Here the rate move looks ordinary and the growth stock reaction looks extreme. That asymmetry is the actual anomaly, not the direction. Before assuming something beyond rates is driving this, check whether the rate story is even internally consistent. Long-duration Treasury bonds should be falling in price as yields rise, and they are. TLT, the 20-year plus Treasury bond fund, is down about 1% this week, and it was sitting in its own tight squeeze right before the move. That confirms the yield move is real and not a single noisy print. Three separate markets, the 10-year, the 5-year, and TLT, are telling the same story. So the mechanism is active. It is just not obviously large enough, on its own, to justify how oversold Nasdaq became. This is where the honest answer is that we do not have it yet, and pretending otherwise would be the scammer version of this analysis, the one that picks a single clean cause and states it as fact. The useful version names the open questions instead. Was positioning in growth stocks already crowded before the rate move started? Is an earnings or guidance concern compounding the multiple compression? Both can be true, and neither is provable from price and RSI alone. What price and RSI can do is flag the size mismatch and hand you a way to test it going forward. Here is the validation map, and both items are things you can check on a chart yourself. First, watch the sequence, not just the levels. The 10-year hourly RSI is now in the high 50s and cooling. If Nasdaq stabilizes after that cooling continues, not before it, the simple rates explanation holds up, because the stock reaction was just a lagged echo of a real rate move. Second, watch TLT's squeeze resolve. If it releases and the 10-year settles near 4.68% instead of pushing higher, the rate side of this story is finished. Anything Nasdaq does after that point is being driven by something other than yields, and that would tell you the size mismatch was never really about rates. So why did a 2.5% move in the 10-year coincide with a much larger move in growth stocks? The honest answer is that we know the mechanism is active, TLT and the 5-year confirm it, but we do not yet know whether it is sufficient on its own. That gap between a confirmed mechanism and a proportionate explanation is exactly what this market is still pricing. The next time a rate move and an equity move happen together, Do not just ask whether the direction makes sense. Ask whether the size makes sense, and check a third market to see if the story holds together. That is the experiment. Subscribe for the next weekend lab, and follow the daily market notes at Market Validation Lab on X, where this size mismatch gets tracked to whichever answer it lands on.